Right now, there's one move happening thousands of miles away that can hit your stocks, your crypto, your retirement account, and even US mortgage rates faster than most people realize. It starts with the Japanese yen doing something that looks small on a chart, but it can trigger a chain reaction because it touches one of the biggest hidden trades on Earth. And when that trade unwinds, it doesn't unwind politely. It unwinds like a crowded theater when someone yells, "Fire." If you want calm, simple explanations of market moves like this without the finance jargon, take 1 second to like and subscribe. I make these updates for a US audience, and subscribing helps you stay ahead of the story before it becomes a mainstream headline. And just so we're clear, this is educational only, not financial advice. Now let's talk about what's breaking here, because the phrase yen move sounds harmless until you understand what it's connected to. For years, Japan has been the land of ultra-low interest rates. That created an opportunity that big money loves: borrow in yen at very low cost, then use that borrowed money to buy higher yielding assets somewhere else. US bonds, US tech stocks, corporate credit, emerging markets, sometimes even crypto. That strategy is called the carry trade, and it works as long as the yen stays weak or stable and the borrowing cost stays cheap. Here's the part people miss. The carry trade isn't just a trade, it's a global funding habit. It becomes part of how portfolios are built and how risk is taken across the world. So when the yen suddenly strengthens, or when Japan signals higher rates or tighter policy, that funding habit gets disrupted. And when funding gets disrupted, risk assets can start acting stressed. Think of it like this. Imagine you've been paying for everything with a super low interest credit card for years. You're comfortable, you're spending, you're investing, you're taking bigger risks because the monthly payment feels easy. Then one day the bank says, "We're raising your rate. And by the way, your balance is now more expensive to carry." You don't just shrug. You start cutting spending, you sell things, you reduce risk. That's what the carry trade unwind feels like, except it happens across institutions, across markets, and sometimes across multiple time zones in a single day. So why does a stronger yen matter? Because if you borrowed yen to buy risk assets and the yen rises, your debt just got more expensive in your home currency terms. Your hedge costs can jump, your profits shrink, your risk manager starts calling. And some players don't wait around to see what happens next. They exit. That exiting can create a feedback loop. Selling pushes markets down, volatility rises, more positions get forced to reduce, and suddenly the move looks bigger than it should. Now, I want to keep this grounded. Not every yen rally causes a crash. Not every policy hint from Japan becomes a global shock. Sometimes these moves fade. Sometimes they stabilize. But when people use the word unwinding, they're pointing to a real mechanism, crowded, leveraged positions that depend on calm conditions. And when calm conditions change, the unwind can accelerate. Let's make the carry trade feel real with a simple story. Picture a massive fund manager who wants more return than safe assets can give. They borrow in yen at very low cost. They convert that yen into dollars. Then they buy US assets, maybe long-dated treasuries, maybe investment-grade credit, maybe mega-cap tech, maybe a basket of growth trades. For a long time, it works. The yield difference pays them. The yen stays weak. Everybody looks smart. Then the yen starts rising, and suddenly their cheap funding is not cheap anymore. And the scary part isn't even the first fund. It is the fact that many funds tend to crowd into similar strategies because the incentives are the same. When something looks like free carry, it attracts size. When it attracts size, it becomes systemic. And when it becomes systemic, it becomes fragile. So what could be behind Japan's move? Usually, it's some combination of higher Japanese inflation pressure, changes in Bank of Japan policy, shifting expectations about rates, and changes in Japanese bond yields. Even subtle policy language can matter because markets trade expectations, not just actions. If traders believe Japan is moving away from ultra-easy policy, they reprice the yen and the cost of hedging. And that repricing is what can start the unwind. Now let's connect this to the US, because you might be thinking, okay, but why should I care if I live in America? Here's why. The US market has been the main destination for global capital for a long time. US equities, US Treasuries, and US credit are deeply tied into global funding flows. When a funding source like the yen carry trade gets stressed, it can pull liquidity out of US risk assets. Liquidity is the oxygen of markets. When oxygen gets thinner, prices can drop faster than people expect. This is why you'll sometimes see days where nothing big happened in US news. But the market acts nervous anyway. Under the surface, a funding mechanism is tightening. The story isn't always a headline. Sometimes the story is the plumbing. And this is exactly why risk assets are at risk. The carry trade unwind can hit the types of assets that benefited most from easy money and stable volatility. High growth stocks, tech-heavy indices, leveraged credit, speculative corners of the market. Anything that depends on investors feeling brave and financed. When financing gets expensive, bravery gets expensive too. Let's talk about how the unwind actually shows up on your screen, because this is where people get confused. They'll see the yen strengthening and assume it should be a local Japan thing. But then USS stocks dip, crypto gets hit, and they wonder why everything is moving together. It's because the same players often hold multiple risk positions, funded the same way. When they reduce risk, they reduce it everywhere. It's not personal to any one asset. It's portfolio level de-risking. Another reason it can look sudden is that many strategies today are systematic. Trend following funds, volatility targeting funds, risk parity strategies, these can all adjust exposure quickly when volatility rises or correlations shift. If the yen move sparks volatility, these systems may reduce exposure automatically. That can turn a normal pullback into a sharp move, not because the world ended, but because the market structure amplifies it. Now, I want to address one misconception. Is this just Japan dumping US assets? Sometimes Japanese institutions do shift allocations when domestic yields rise because they can get acceptable returns at home without taking currency risk. That can matter, especially in bond markets. But the carry trade story is broader than one country selling. It's about global leverage and global funding costs changing. That's why the impact can feel outsized. So what do you watch if you want to know whether this is a brief scare or the start of a larger unwind? You don't need 20 indicators. You need a few clean signals. First, watch the yen trend itself, especially whether strength is persistent for multiple sessions instead of a one-day spike. If the yen strengthens and holds, it pressures carry positions longer. If it reverses quickly, stress can fade. Second, watch volatility. When volatility rises, leverage becomes uncomfortable. Even if prices aren't collapsing, higher volatility forces some strategies to reduce exposure. If volatility keeps climbing while the yen strengthens, that's when the unwind story gets stronger. Third, watch US yields, especially longer-term yields. A Japan-driven shift can ripple into global bond markets. If global yields move up together, that tightens financial conditions. In the US, tighter conditions can hit housing, credit, and equities, sometimes with a lag, sometimes immediately. Fourth, watch credit spreads. Equity drops can be noisy, but credit spreads widening can signal that stress is moving beyond traders and into financing conditions. When credit tightens, risk assets usually feel it. Now, let's make this more personal and real. If you're a US investor, your biggest risk is not always a company's earnings. Sometimes your biggest risk is a sudden change in the cost of money. Carry trades are basically a bet on cheap money staying cheap. If Japan is signaling that cheap money may not stay as cheap, then the entire global risk mood can shift. And here is the twist that keeps people watching once they understand it. Japan is not a small side character. Japan has one of the largest bond markets in the world. It's been a cornerstone of global low-rate policy for a long time. That means even small policy shifts can feel like someone tugging a load-bearing beam. So when people say Japan pulled the plug, what they really mean is the market is starting to price a world where one of the last major sources of near-zero funding is becoming less reliable. And if that's true, we're not just talking about Japan. We're talking about the cost of leverage across the global system. Now, does this guarantee a crash? No. Markets can adapt. Central banks can adjust messaging. Flows can shift gradually. But it does raise the probability of turbulence, especially if markets were priced for perfection. And I want to say something important here. Turbulence doesn't always come with scary headlines. Sometimes it comes with small, repeated risk-off days that slowly change behavior. People stop buying dips aggressively. Liquidity dries up at the edges. The weak assets start to underperform. Then, one day, something breaks. Not because the first event was huge, but because the system was already stretched. That's why the carry trade story matters now. It's not only about today's move, it's about positioning. If markets are crowded, leverage is high, and funding starts tightening, the unwind can become self-reinforcing. Let's talk about the why now question, because it matters for understanding the urgency. In many cycles, the most dangerous moment is when everyone believes volatility is dead and funding is stable. That's when leverage quietly builds. That's when people reach for yield. That's when portfolio risk gets disguised. Then a funding currency moves sharply, and suddenly everyone discovers they were standing on the same trapdoor. So if you're watching breaking yen move, the key is not to panic. The key is to recognize that the yen can function like a stress indicator for global risk appetite. A strengthening yen can be like a flashing yellow light. Leverage is becoming more expensive, and the market might need to reprice risk. Now I'm going to give you a simple way to think about what might happen next. And I want you to listen for the logic rather than the prediction. There are three broad paths. One path is the fade. The yen move cools off, policy fears calm down, and risk assets stabilize. This happens when the market got ahead of itself, or when the move was mostly positioning. Second path is the grind. The yen stays firm, volatility stays elevated, and risk assets drift lower or chop around. This is the most common unwind path because Big positions often come off gradually, especially if liquidity is thin. Third path is the snap. The yen strengthens quickly, volatility spikes, and selling accelerates due to forced deleveraging. This is the path people remember because it feels sudden. It often happens when a key level breaks, margin requirements bite, or a systematic strategy flips quickly. You don't need to guess which path we're in by emotion. You watch the signals, yen persistence, volatility persistence, and whether liquidity looks thin. Now, a big question I see in comments is, if risk assets fall, where does money go? Often, during de-risking, money goes toward cash, short-term treasuries, or defensive assets. Sometimes gold benefits. Sometimes the dollar strengthens temporarily because global stress creates demand for dollars, but it depends on the exact driver. If the driver is yield differentials and Japan tightening, the dollar-yen relationship can get complicated, and that complexity is exactly why moves can be choppy. And yes, crypto can be vulnerable in these moments because crypto often trades like a high beta risk asset when liquidity tightens. That doesn't mean crypto can't recover later. It just means it can get hit first during funding stress. Now, here's what I want you to remember, because it is the key point that explains why this isn't just Japan news. The carry trade is essentially a hidden leverage pipeline feeding global risk. When that pipeline tightens, it affects the entire risk complex. The market is like a living ecosystem. If you squeeze one major source of cheap funding, everything that relied on that funding starts to adjust. So what should you do as a regular person watching from the US? First, don't confuse awareness with action. You can watch a story without making a rushed move. Second, if you're invested, understand your own exposure to risk assets and volatility. Third, pay attention to liquidity and funding indicators, not just headlines. Most people watch earnings and political news. Professionals also watch funding conditions. Now, I want to keep your curiosity alive until the very end with one question that matters more than any chart. If the yen keeps strengthening, who is forced to be the buyer of risk assets during a sell-off? That question tells you whether dips get bought fast or whether they keep falling. When funding is easy, dip buyers appear quickly. When funding is stressed, dip buyers become picky, and markets can gap lower before support returns. So here's your tomorrow watch checklist in plain English, and you can literally use it in 60 seconds. Watch USD, JPY direction, and speed. Slow moves are manageable. Fast moves can force position changes. Watch the VIX, or overall volatility tone. If volatility keeps rising, systematic de-risking becomes more likely. Watch US bond yields and whether they're moving with global yields. Higher yields can tighten financial conditions. Watch the broad market leaders. If mega-cap tech starts rolling over together, that's often a liquidity signal, not just a company story. And watch whether rallies get sold quickly. In healthy markets, rallies hold. In stressed markets, rallies get faded. Now, I want to be honest about something that's emotionally hard for people. The market rarely gives you a clean, comfortable warning sign. It gives you confusing signals. One day stocks are down, next day they bounce, then the bounce fails. Meanwhile, the yen keeps grinding. That's how the unwind often looks early on. Messy, not dramatic. But understanding the mechanism helps you stay calm. Instead of thinking the world is ending, you can think funding is tightening and leverage may be coming off. That's a professional way to view it. It keeps you from making emotional decisions at the worst time. And this is why I'm covering Japan right now. Because when the carry trade unwinds, it can be one of those behind-the-scenes stories that explains a lot of random market behavior all at once. Now I want to hear from you. In the comments, tell me what you're watching most closely right now. US, stocks, crypto, bond yields, or the dollar-yen chart. And if you want, tell me your biggest question about the carry trade, because I can make a follow-up that breaks it down even more simply with real examples. If you found this useful, please share this video with one friend who keeps asking why markets feel shaky for no reason. This is often the reason, and sharing helps more people understand the plumbing before the panic headlines show up. Stay calm, keep it simple, and watch the funding. Because when the yen starts moving the wrong way for carry traders, it's not just a currency story anymore, it's a risk asset story. And the earlier you understand that, the less surprising the next move will feel.